Hey everybody, this is Jose Blasco, ready to begin the session today, March 7, 2022. As we are getting started, as always, it would be very nice if you could just send a quick message that says that sound is good and you hear me well and all is good. Should be the case, but again, always a good thing to reconfirm as we get started, so everything is smooth during the session. Also, you see me looking right and left because I am positioning the chat boxes in the right place so I can read the messages that you guys send during the session. So please feel free to be ready to be engaged, to ask questions, no matter if they are basic questions or very advanced. I will be very happy to receive both the very advanced and the very basic questions and anywhere in between to make this session count. Okay, so let's get started with our SMARTT Target Live session. My name is Jose Blasco, not sure I said it. You can see the email on the screen as well, in case you have any question for me after the session is over and you need to contact me to review or anything. More than happy to help myself as well as our support team. Anyway, so the plan for today, we're gonna go through introductions very quick, in case you have not been in a session with me before. So I will introduce myself briefly, because this session, as I always say, it's really about you. It's not about me at all, even though I guess that it helps to know a little bit more about where I'm coming from a trading point of view. We'll talk about key headlines, even though I guess we all know the headlines, unfortunately. From there, we'll move into an option lesson for the day. Today, we'll be talking about extrinsic versus intrinsic, which is such a very important foundational concept of options trading that needs to be well understood. So I'm counting on you guys to listen carefully and also to participate of the sessions, as I said before. And I have a bonus for you that I will make available right after our special market commentary, which is obviously the title of the session for today. And questions and answers, we could certainly have them at the end, but I welcome you as well to type as the session goes live whenever you have any question. Okay, so I can see, thank you for your messages, by the way, with confirming that sound is good and everything else. This is very appreciated. Also on the screen, you can see there is a QR code. This QR code is from Tiger Brokers. This is a zero commission card for US options trading. So hopefully the knowledge that you acquire in these sessions that we are running gets you to a point where it's time to execute a trade. This commission card, zero commission card, I guess is quite handy. So thank you very much, Tiger Brokers, for being so generous, as well as for hosting the session. In this case, for me, guys, it's a pleasure as always to be part of this. So let's begin. Introduction, super quick. My name is Jose Blasco. I trade since 2008. I trade all assets because everything in life got pros and cons. And trading is the same. Futures, stocks, options, they're all great, but they all have pros and cons, advantages, disadvantages. So the key is to get to understand what are the assets that match you better, or your trading plan, or your goals in trading, and so on, and utilize whatever is more efficient, like in business, really, because trading is indeed a form of business, isn't it? Options is my favorite. So every time we get together to talk options, I am super excited. I really enjoy trading in general, but options, take it to the next level. So again, thank you for joining me today and allowing me to have a little bit of fun here in the session. Hopefully you will also enjoy it and have fun yourselves. Our company, our website is www.tradewithufos.com. You have another QR code on the screen in case you wanna click on it using your phone. You may wonder, what are the UFOs? Well, you will see in a moment. You will see them in a moment on my screen as I jump into real-time charts. The UFOs, they look like flying saucers. They represent on-field orders. And basically, those are very relevant price points on the chart that potentially can act as very powerful support and resistance levels. Therefore, they are commonly used for entries and exits, to be very precise. And many traders use them by themselves. Many traders as well combine them with other trading techniques. Okay, so this is kind of like the bread and butter of what we do as a company. I'm also very passionate about trading technology, and I'm very much into UFOs, as you could imagine. Headlines, well, to be honest, the two key headlines that I have here, if you recall last week, are exactly the two same headlines. Russia-Ukraine geopolitical tensions and the US fighting inflation. And I was even tempted to add the world fighting inflation now, because energy, it's becoming so expensive everywhere that, beyond problems of certain countries, such as the US, really the conflict, the tensions in Eastern Europe right now are spreading worldwide in different forms. And we are looking at a potential economical, problem, which, again, it's delicate to say. It's always sometimes even difficult to separate, right? But I like to think of wearing two different hats. The hat that you wear, when you are, walking around the city, and the hat you wear when you are sitting in front of your computer planning on a trade. So we always want to, of course, be very mindful and sensitive to what's happening in the world. And I guess we are all, to a certain degree, concerned about what's happening in the world. But on the other hand, now we switch hat as a trader, and we also need to understand that those geopolitical events, they are source of market opportunities. Of course, in markets that typically are going to be more volatile, and therefore we need to be careful to not to get hurt. But certainly the opportunities are there, and the idea is to have the knowledge, the tools to identify such opportunities and execute them safely. Okay, so today the lesson that we're going to discuss on extrinsic versus intrinsic values in the world of options trading. Hopefully we're bringing a little bit more understanding of options trading, and that it's, moving towards the goal of, being safe in trading while using powerful assets, powerful markets, even in cases when the markets are very volatile, like, in these days. Earnings reports are not a headline, but if you wish, is the biggest headline for companies. So today we got 165 earnings reports being reported in the US markets, where I picked 3 as the most relevant because those companies are indeed quite relevant in today's earnings, which is Sienna Corporation, VBI Vaccines, as well as EDU, New Oriental Education and Technology Group. So again, if you happen to be trading those stocks or are planning to entering a trade on those stocks, make sure you watch for those earnings reports, because as you probably know, when reports are becoming public, stocks often tend to jump on such news, either up or down, depending on the report and was it a surprise, what is expected, was it a big surprise, a small surprise, etc., etc. Okay, so those are important pieces of information to keep in mind. Now, as we are now aware of this, let's jump into our options lesson. So later from there, we're going to move into our SMARTT market report and understand the markets better. But before, let's go over the lesson. So the lesson for today is intrinsic versus extrinsic values. Are they our enemies when trading options, or are they our friends when trading options? Okay. And of course, the first question is, what's extrinsic and what's intrinsic? That's probably the first question we need to answer to be able to assess if intrinsic or extrinsic values are helping or hurting our trades. So the first thing that we need to do is to understand better what they are. So I'm pretty sure that some of you, and please go ahead and interact with me on the chat box. This would be the time. I'm counting on you all. Okay, guys, no exceptions out there. Please, if you guys already know what is intrinsic or extrinsic, type yes. If you guys never heard about this, or maybe you heard about it, but you don't know exactly what it is, please type no. Okay, so that way, I get a feel for, how deep I need to get into, how much I may need to repeat. Happy to adapt to you guys. So I need your participation at this moment in time, so I can measure where you are at when it comes to options, trading, and knowledge better for today's session, also for future sessions, because we're meeting again next Monday, isn't it, guys? And I have more topics that I want to bring to you, but of course, with the intention of helping you instead of boring you with things you may already know. So I need your participation here to get that confirmation. So every options contract got 2 portions. Okay, so let's say we have an example here, which is an options contract worth $1.5, right? And if you recall from when we define what's an options contract, we said the price of an option is normally not called the price of an option, is normally called the premium. So you buy an option, you pay premium, you sell an option, you receive premium. Okay, please do not be shy, okay, with the yeses and the nos, guys. I would love to get a bit more participation. That would be very appreciated. And this applies to everywhere in the Tiger app, as well as in the YouTube channel and everywhere else, okay? So please participate. I'm watching you all, guys. I want to know, I need to know. So let's say you are looking at an options contract and that contract is trading at $1.5, where that value of 1.5 is actually coming in by adding up two pieces of information, which is the intrinsic value portion of the contract plus the extrinsic value portion of the contract. So first thing we need to know is that each price, each contract has two pieces of value that put together give us the total amount of premium to be paid or to be received when buying or selling the contract. So now we need to understand better what is intrinsic and what is extrinsic. I want to also point at the fact that extrinsic value is also known or seen, or you can, if you read an options book, for example, some options books will refer to extrinsic value as time value, and I will explain that a bit better later. Why is that? It's the same thing, okay? So the time value, the extrinsic value is the same thing. So a right, and we know that options contracts provide a right, isn't it? A right may be an advantage. And if you have an advantage, then there is intrinsic value, okay? There is something tangible that is helpful, it's intrinsic. Okay, so you may want to think of an advantage. Okay, so let me read the slide, even though I'm not a fan of reading slides, but let me read that definition because it's important. I don't want to miss any word. So it says that each options contract conveys a right which allows to obtain shares, either long if it's calls or short if it's puts, at a certain price before a certain date, which is the expiration date, through exercising the options contract, which could be a call or a put. In other words, let's say you own a call and you exercise. Well, if you own a call and you exercise, you end up with long shares. Let's say you own a put and you exercise. You end up short shares. That's your right, okay? You have the right to obtain shares, either long or short, depending if it's a call or a put, if you choose to exercise. Now, the question is, when would you want to exercise? When would you want to convert your options contract into shares? Well, only if you have an advantage. It would not make sense to convert an options contract into shares if you ended up with shares at a worse price than the current price of the shares. Let me explain that with specific figures. We have an example here where a traders, let's say you, own the 30A call. Okay, and thank you for your responses, by the way, guys. That's very appreciated. Thank you so much. So let's say you own the 30A call. If you have the 30A call, because it's a call, you have the right to buy shares of that stock at 38 if you exercise the call. Well, that's an advantage if the stock is above 38. Let's say the stock is trading at 50 and you have the 38 call. Let me repeat. You have the right to buy the stock at 38 while the stock is actually trading at 50. That's an advantage. You would collect $12 in profit, which is the difference between 50 and 38. You have an advantage of $12. Therefore, there is intrinsic value. Now, what if the stock was below 38? So again, you own the 38 call, and let's say the stock is trading at 30. So why would you exercise the right to buy at 38 if you could go ahead and purchase the stock at 30 in the market? It doesn't make sense. That 38 call is not useful, and not being useful, that 38 call has no intrinsic value. Therefore, it's only extrinsic. There is no intrinsic value. Intrinsic value would be zero. So please let me know how is it going so far, guys, with a quick okay, not okay on the chat box. Again, let's get into the habit of communicating and interacting to each other, because again, it's critical for me to help you understand this better. Options are amazing, but you gotta understand them before you trade them. And I really want to help you and make an impact on taking you to the next level. So I need your feedback, my friends. Now, let's talk about the put example while I'm waiting for your feedback. So the put is the inverse of the call. So if you exercise a put, you have the right to obtain shares, but you obtain shares short. So you have the right to sell shares. So if you have the 47 put, you have the right to sell shares at 47. That's only an advantage if the stock is below 37, right? So let's say the stock is trading at 40 and you have the 47 put. Well, by owning the 47 put, you have the right to sell the stock at 47 while the stock is trading at 40. That's an advantage because you have the right to sell the stock $7 more expensive than the current price of the stock, which is 40. So there is intrinsic value because there is an advantage. The opposite is also true. So let's say the stock is trading at 57 and you own the 47 put. Well, if you own the 47 put and the stock is trading at 57, why would you exercise your put and sell at 47 while you could go ahead and sell the stock now at 57, which is $10 more expensive? You want to sell expensive, you don't want to sell cheap, right? So selling at 57 is better than selling at 47. So it's not useful to own the 47 put. Therefore, that 47 put has no intrinsic value. So the right may or may not be an advantage. If the right you have by owning a call or owning a put happens to provide an advantage, then there is intrinsic value. So the intrinsic value is the value built in an options contract as a consequence of such advantage. Let's be a bit more detailed, even though it's kind of the same. So you own the 38 call. If the stock is trading at 45, you have an advantage of $7. Therefore, the intrinsic value is 7, right? And then we'll have also extrinsic value, which can also be seen as time value because the option hasn't expired yet. So you would have to pay more than 7 for that option. But right now we are only dealing with intrinsic. So intrinsic would be 7. What if the stock is trading at 37? Well, 37 is below 38. So that option is not useful. So intrinsic value is 0. Now, of course, you still have time to expiration. So there will be some extrinsic value because from now until expiration, the stock may rally and go above 38. And some people may want to pay for that. So that extrinsic value portion of the option will be available, even though, from an intrinsic value point of view, there will be no value. Thank you so much, guys, for those okays. Also, JJ Wong, what do you think of Hong Kong options? I already own Hong Kong shares, but it seems that not much people talk about Hong Kong options. Here we go. Yes, reading. Very good, perfect. Okay, so my focus is US options because they happen to be the most liquid options in the world. Obviously, the Hong Kong market is of a smaller size compared to the US, and therefore the options markets are also smaller. So from that point of view, you have a little bit less of an advantage given the size of the options market being a little smaller, but at the same time, it doesn't mean it's wrong to trade Hong Kong options. Actually, it's very often, precisely because the market is a bit smaller, you often find options with very nice intrinsic values and things of that sort, which make those opportunities even more unique than a large market like in the US. So the good news, while I'm not focusing on the Hong Kong options, the good news is that what I'm covering here applies directly to Hong Kong options or options anywhere else in the world. Okay, so you can take those concepts and extrapolate and use it for your own. And for sure, if you have further questions at the end, I will share my email again, and more than happy to receive your questions. Thank you for that, JJ Wong. So anyway, so with the 47 put is the same story. If you own the 47 put and the stock is trading at 42, you have an advantage. How big is the advantage? The difference between 47 and 42, which is $5. So how much is the intrinsic value? 5. The stock is trading at 48. Well, why would you sell the stock at 47 since you could sell it at 48? The 47 put is not useful, therefore it has no intrinsic value. Intrinsic value is 0. So again, very basic concept. I have to say maybe just a little bit in the boring side to go through very basic math like this. And sometimes, while it's very basic, sometimes it's also a bit confusing, especially when you think of the put side. So again, that's why I have repeated kind of like the same 2-3 times. So I make sure you guys get it. And also, if anyone wants to need a copy of the slides or anything like that, more than happy to send. Okay, so just email me and I'll be happy to help with that. So you can reread it one more time or watch the recordings of the videos one more time. So take a look at, now that we saw some specific examples on the slides as, you know, lecture time, if you wish, let's look at some real examples so we get to understand this better. So in this particular screenshot, we are looking at an option chain with McDonald's, where the current stock, the last price of McDonald's at the time of the screenshot was $240.94. And at that moment in time, the trader who is looking at options that expires in March 18, which is 16 days from now as the screenshot was taken. So those options, the 235 call, which is the one highlighted with a 235 strike. So that option has a bid price and an ask price of 860 and 890. So the midpoint happens to be 875. So as you can see on the bottom part of the screen, the value of that option, we call it premium, is $8.75. Now we know the value of that option is made up two portions, which is the intrinsic value, which we just learned how to calculate, and whatever is left is going to be extrinsic, because it's whatever amount of extra premium people want to pay just because there is extra time to expiration, which is the other reason why extrinsic value is also known as time value. So let's calculate the intrinsic value. Well, the distance between the strike, 235, to the current price of the stock, 240.94, that distance is $5.94. And given the fact that the stock is trading at 240, if someone had gifted you the 235 call, please type on the chat box, would you be happy or unhappy if someone gifted you the 235 call while the stock was trading at 240.94? Would you be happy or unhappy if someone had given you that particular call, the 235 call? Okay, so happy or unhappy, that's the answer I'm looking for in the chat box. Would you be happy or unhappy if someone had given you the 235 call while the stock was trading at 240.94? Let me know. I'm watching. I need a few answers from you guys. Happy or unhappy of getting those options? Happy. Thank you so much. Yes, indeed. Why would you be happy? Well, because the 235 call gives you the right to purchase the stock at 235, and given the fact the current price of the stock is 240, so that's let's call it an automatic profit there, right? How much is the size of the advantage? $5.94. Therefore, that's the intrinsic value, and therefore whatever is left, which is, if you do the math, is 281. 281 plus 594 equals $8.75, which is the real-time price of the option at that moment in time. Super happy. Very good. Very happy. I love it. Indeed. So, you may want to think about that. Intrinsic value makes you happy. Intrinsic value is an advantage. Okay. You may want to think about it this way. Now, what is the extrinsic value? Well, the intrinsic value is whatever is on top of the intrinsic value. In the example we just observed, the intrinsic value was $5.94, but the value of the options contract was $8.75, meaning that there were $2.81 of extrinsic value or time value, which is whatever is on top of the intrinsic value. It represents all the other factors that are part of the options price. Most importantly, and that's the reason why it's also called time value, the fact that it represents whatever amount of money people want to pay as the hope that from now until the expiration date, the stock will move from whatever price to higher than the strike, in this case, higher than 235, and start making money on intrinsic value. Because here's the thing, extrinsic value decays and becomes zero on expiration because there is no time left. The option has expired. Therefore, time value, which is the same as extrinsic value, becomes zero. But intrinsic value does not decay. Intrinsic value does not decay. So when people are paying for options which have no intrinsic value, you will wonder, why are they paying for an option that has no intrinsic value? Well, because whatever amount of money they are paying is their bet on having the stock then moving up or down, depending if it's a call or a put, and be beyond the strike price, providing an advantage, providing intrinsic value. So now when the option expires, even though the extrinsic value becomes zero, well, the intrinsic value does not decay, and therefore that's a net profit. Okay, so that's basically what extrinsic value represents. Okay, it measures all the other factors. For example, now there is a major conflict in Eastern Europe, as we all know. So obviously this is scaring everybody. Many people are buying a lot of options, for example, for protection puts, and they buy them below price, which means they have no intrinsic value, but they buy them just in case the stock market falls and crashes very hard. So as the stock market crashes and falls very hard, those puts now will gain intrinsic value and will start paying them, even though the extrinsic value will decay and become zero, the intrinsic value will not. So basically the amount of money they are paying on extrinsic value now represents their expectation for the future movement from now until the expiration date. So it really represents all the other factors, but again, not to get too complex, you may want to think of extrinsic value like whatever is on top of intrinsic value. That's it. That's probably a simpler way to think about it. So example, let's say a stock is trading at 45 and someone has given you the 38 call. Well, you would be very happy, as you have said. You would be super happy, isn't it? Half poo. And you would be very happy because that option got intrinsic value. How much is the intrinsic value? 7. The difference between 38 and 45 is 7. But if the current price of that call is 7.8, what does that mean? It means that you have 0.8 dollars of extrinsic value, right? 80 cents of extrinsic value. If the 48 call is priced as 3 cents and the 48 call provides no advantage, it's useless when the stock is trading at 45, isn't it? So it means it has no intrinsic value. Well, if that option is trading at 30 cents and it has no intrinsic value, it means that 30 cents, the whole 30 cents is extrinsic value. If you look at the 47 put, and the 47 put is trading at 3.8, and the current stock is trading at 45, well, the 47 put gives you the right to sell at 47. If the current stock is at 45, that's $2 lower, right? So you have $2 of intrinsic value, right? Well, if the price is 3.8, it means that on top of your $2 of intrinsic value, you got $1.8 of extrinsic value. And if you own the 41 puts, which gives you the right to sell at 41, but the stock is currently trading at 45. So my question is, why would you sell at 41 if you could sell at 45? In other words, the 41 put is not useful at this moment in time, but still people are paying for it just because they expect something to happen before now until expiration. So let's say people are paying 10 cents for that. So 10 cents would be extrinsic value. Now, final question here before we jump into the real-time charts, okay? Which it's going to be important, to do our market review, isn't it? Final question to make sure you guys got this. Question: which type of value expires and becomes zero on expiration? The intrinsic value or the extrinsic value? Please type it on the chat box. Which type of value in the options world becomes zero on expiration day? Is it the intrinsic or is it the extrinsic? Fairly easy question to answer. I just want to make sure you guys followed me. So please type it in the chat box so I know you are with me. While you're doing that, let's review very quickly. Same option chain with McDonald's, same current stock price, 240.94. But now instead of looking at the 235 call, I'm looking at the 247 call, which is an option which has no use at this moment in time, because the 247.5 call gives you the right to buy at 247.5, where the current value of the stock is 240.94. That's not useful. So how much is the intrinsic value? Zero. Okay, as we have seen on all the other examples. The intrinsic value is zero. But what about the extrinsic value? Well, the extrinsic value is 2.8. which happens to be the midpoint between the bid and the ask. People are paying $2.08 for that option just because from now until March 18, at the time of the screenshot, there were 16 days to expiration, and therefore they were hoping that in those 16 days, the price will move from 240 to 247.5, and there were some people buying that option at that particular price, okay? But it was all extrinsic value, meaning that if that stock does not rally to 247.5, remember, as you guys answered perfectly on the chat box, thank you so much for your participation, I so appreciate that. So as you guys have answered perfectly, extrinsic value becomes 0 on expiration. So if you buy that call and the stock does not rally to 247.5 or above from now until March 18, guess what? The $2.08 you paid are gone. You lost it all, right? Because you didn't buy intrinsic value, you bought extrinsic value, and extrinsic value decays. So now I'm ready to get into, is extrinsic or intrinsic our friend or our enemy? Because based on what I just said right now, probably you're thinking, wow, extrinsic is a problem. If I buy it and the stock doesn't move, I may lose it all, right? So let's summarize which one is your friend, which one is your enemy, and in which context, because this is a really important foundational concept in options trading, to not to make mistakes, okay? Not to make mistakes. Question for you guys, by the way, in the chat box, as I get to cover this with more detail about enemy or friend. Question, has anyone in the group, and you know, again, this is a little bit of a personal question, so if you don't want to answer, in this case, I kind of understand, even though it would be very good for the group if you could share your experience, because it would certainly be helpful. So has anyone in the group ever bought an option? For example, you bought a call and you saw the stock move your way, right? So the stock was moving your way, but you ended up losing money. You did not make money. Has that ever happened to you? Okay, so this is the question. Please type the answer in the chat box. If this ever happened to you, you bought an option, the stock moved in your direction, but you did not make money. You actually lost money, or maybe you made a little bit of a profit, but it was a very tiny one, very disappointing. Okay, so if that has ever happened to you, please type it on the chat box. Again, that would be great for the community to see your answers. So when buying options with intrinsic value are going to be more expensive because the value of an option is intrinsic plus extrinsic. So if the intrinsic value is whatever amount, so that's going to make the option more expensive versus buying an option which has no intrinsic value at all. But theoretically, you are more likely going to profit. Okay, and why is that? Well, because for the option to have intrinsic value, it means that the option you bought is already, as you start the trade, that option is already providing you with an advantage. That's why it has intrinsic value. So for you to lose money on the trade, you need the stock to go against you by a certain amount, and then you're going to start losing, right? Where if you were to buy options with no intrinsic value, they are going to be cheaper. Some of them are going to be super, super, super cheap. And you may be like, okay, I'm going to buy, I don't know, Google, Amazon, which is one of the most expensive stocks in the US, right? So I'm going to buy, an option with no intrinsic value, very far out, and I'm going to pay $50 for the option. Well, yeah, it's going to be cheaper. But theoretically, way less likely going to profit with that trade, because while it's cheaper, the only way you profit on the trade is by having the stock move by a large amount until that option that had no intrinsic value when you purchase it now has intrinsic value. So it does require a very large movement on the stock for you to profit. So in other words, when buying options, okay, you may want to think of intrinsic value as your friend. Why? Because in one hand, it makes the trade more expensive. That's not really your friend. But at the same time, that a little bit of an extra price you pay is really helping for you to increase your odds of profitability. Just from a pure probability point of view, putting on the side trading methods, trading with the trend, trading against the trend, putting all of that on the side, just pretend anything could happen anytime, just like, like 50-50, like flipping a coin. So if you were to think about it this way, intrinsic value does help because you are starting with some sort of an advantage. So in order for you to lose, the advantage needs to be taken away from you, which means the stock has to move against you. Where in the other case, when you buy options with no intrinsic value, You may actually have the stock move your way, but if it doesn't move enough, you may lose it all because you never got to a point where your option gained intrinsic value. And remember, extrinsic value decays as time passes. So if the stock didn't move fast enough and expiration date took place, everything you paid for the option was lost. So as you saw, actually, I will share my screen with a platform in a moment. Okay, so let me show you that in a moment. I will be more efficient with the time. So I will show you the option chain, and you will see how there are multiple strikes available. So selecting the right strike for your trades is quite critical in order for you to minimize the problem of getting into trades that are very cheap, which is nice, but they are so cheap that then the probability of you ended up in a profit is so low that basically you ended up buying what we professionals often call a lottery ticket. So you bought an option which is so cheap, so cheap, so cheap. Well, yeah, it's very cheap, but the probability of it to provide a profit is basically nothing or close to none. That's why it's that cheap, right? So again, when buying options, intrinsic value is your friend because it does not decay and it does provide that advantage that you may want to consider starting with. When selling options, the opposite is true. And by the way, thank you for your answers, and very generous of you guys, for the ones of you that have traded options before, to share that you had experiences of that sort. Options, I told you at the beginning of the session that is my favorite asset to trade because there are different moving parts with options, okay, where you can tweak things here and there, and you can do things that are so interesting that really help profitability and reward to risk ratios, win-loss ratios. You can do many things that are very intelligent, which we'll discover little by little, one step at a time in the Tiger Live sessions. But having said that, precisely because there are multiple moving parts, I have seen sometimes that traders get into a trade and maybe they only get into a trade because that call is only $200. Okay, I'll get it. And you didn't think beyond the price of the call was $200 and that was okay for you, for example, and you got into the trade without realizing that maybe you had no intrinsic value, you had no extrinsic value, and next thing you know, now you're in trouble and you don't know why. Okay, so I wanted to bring in that to your attention. We'll need to dive deeper into this, okay, big time. But again, at least in today's session, hopefully I am starting to open your eyes to some important, relevant aspects of understanding options pricing. When selling options, okay, options with no intrinsic value are cheaper, but theoretically more likely to profit. Okay, why? Because the fact that they are very cheap means that very few people are buying them. And if very people are buying them, is because no one believes that market will move all the way to that price level. And that's why they are very cheap, because no one is buying them. If everybody believed the market would get to that point, everybody would be buying that call, that put, and therefore that option would be very expensive. And that means that now it's getting intrinsic value. So again, the cheaper they are when selling options, the less likely, the more likely you will profit when you sell them. Because when you sell options that have no intrinsic value, you are basically selling extrinsic value, and extrinsic value decays, meaning that it will become zero. So if you sell something and you get paid $2.08, and the stock didn't move against you by that large amount against you, and then March 18 happens, 16 days have passed, and the option becomes zero and it expires, well, you got paid $2.08. The option expired. Guess what? You keep $2.08. So you made money on time passing because the extrinsic value has expired, and because there was no intrinsic value. So you could even afford the stock to move against you by a certain amount, and you're still okay, as long as it doesn't move too much against you. So then you are fine. So options with intrinsic value are more expensive, but less likely going to profit unless the stock was to move by a large amount in the favor of the trader. So in the case of selling options, the opposite is true. Intrinsic value is your enemy. When you buy options, intrinsic value is your friend. Having said that, I also want to add on top of this that 2 weeks ago, when we talked about options for the first time, I also said that a common practice amongst options traders is to combine options contracts So advanced options traders, we buy contracts and we sell contracts combined. We call these option spreads, for example. And then you could actually find balance situations where some option has the help coming from the intrinsic value, but because the intrinsic value is more expensive, now you sell an option against, and because you sell an option again, you diminish the price of the resulting amount you have to pay to be in the trade. And again, options are a beautiful thing to trade because these reasons and more. But in a purist form, if you were to trade one contract at a time, buying options, in the case of buying options, intrinsic value is your friend. In the case of selling options, intrinsic value is your enemy. Hopefully, all of this makes sense, because now we are about to jump into the market analysis. Let me know if you have any question. Thank you so much for your participation on the chat box. I am going to, just give me 1 second here. I am going to share my other screen with the trading platform so we can do the real-time analysis of the markets. So you should be able to see top, which is the platform I use. I want to move into the right slide where we're going to be talking about our SMARTT analysis. We're going to be looking at the market climate and cycles, the implied volatility, the volume map, the UFOs, the open interest, the market projections, and also sectors and groups. So let's go ahead and do this. Let's go ahead and do this. One moment, here we go. Sometimes dealing with multiple screens does that. So let's begin with looking at the S&P futures. Okay, so the chart that we have in front of us is the S&P futures. I'm looking at an intraday time frame. I'm looking at the 34-minute time frame in this particular case, and we can see that S&P futures are, as we speak, down by -1%. So this was the close yesterday. This was the reopen. When I say yesterday, I meant Friday. This is the reopen today. Market open gapping down. Obviously, a huge impact of what's happening in Europe. At the same time, you can see as we speak in front of us, a packet of buy on field orders has just been added to the market. It's just been identified by the UFOs. It just happened in front of us. So nice to see. In other words, buying is coming in. So while the market is opening like close to 1% down, we may have an up there actually intraday trading. It doesn't mean that overall we're going to be in an uptrend. Take a look at the climate. The climate is unconfirmed. By the way, I'm going to grant you free access to Auto Climate for the ones of you that don't have it yet. So after this session, I'm going to give you instructions on how to get your own Auto Climate. So bear with me. I will explain that in a moment. But the climate is unconfirmed. Unconfirmed means the dot is thin. If I zoom in, you will see the difference. That's a thick dot. That's confirmed. That's a thin dot. That's unconfirmed, meaning that at this moment in time, there is a fight. There is not a clear direction in the market, and therefore betting either long or short does not carry a statistical advantage at this moment in time, which this may clarify itself, 10 minutes after the market opens, and we got a thick dot, either red or green, red or blue. But at this moment in time, there is a lot of uncertainty, a lot of indecision in the marketplace, as you can see, coming from Auto Climate. Having said that, with that in mind, we just started an Elliott wave to the downside, which is the reason of that diamond on my chart. Elliott wave means that that price should end up traveling all the way to where this purple box is. Okay, this would be the wave. So this has just been confirmed on Friday, actually. So we just started a wave. Therefore, the fact that we may have an update today doesn't mean that that's it. The market has won and is going to continue resuming and going back higher. We may be in a scenario where the market is going to continue lower, even though it's looking like we're going to have an update thanks to this, stack of on-field orders to buy that just been added in the market at 4268.25 on the S&P futures. And also looking at options data, you can see I got two lines here on the bottom part of my screen. The blue represents the calls, the gray represents the puts, and you can see how the puts is above the calls, meaning that there is much more put buying than call buying at this moment in time. And this is, of course, a very bearish action, very bearish sentiment in the marketplace, which coincides with the fact that we are in a down Elliott wave. And the only thing that is lacking a little bit of confirmation here is the auto climate, which is still looking like neutral. We don't know what's going to happen yet. But when we have the next dot as the market opens, it will reveal itself if it's going to be a down climate or an up climate. So again, if it's a red dot, I would say statistics suggest the market is going to continue falling. If it's a blue dot, then statistics suggest that the market will reverse and go back higher. So we are about to get to see that define itself. What else are we going to see? Okay, well, we just talked about the market climate and the cycles. So I talked about the Elliott wave. I talked about the climate. I talked about the call and the put implied volatility, how the puts are winning, the gray line being above the blue. And I didn't show the volume map. So let's take a look at the volume map. So the volume map, which is right here, it's showing lots of indecision as well, just like the auto climate. In the shortest expiration date, we got 1.3 times more puts traded than call. Remember, the gray color is puts. On the next expiration date, we got 1.3 times more calls traded than puts. Okay, so that's blue color, that's calls. On the next one, the puts win. On the next one, the puts win. On the next one, the call win. On the next one, the put win. So you can see there is a fight. Okay, there is a fight, which is no wonder why the auto climate is giving us a non-confirmed situation. So again, this may clarify, as I said, 10 minutes as the market opens, or maybe we need 1 or 2 days, depending on the battle, depending on those unfilled orders entering the market. But we are at a critical point because it's either that Elliott wave is going to expand or it's going to fail. That's exactly where we're at, having this Elliott wave being defined on the last Friday. So we're going to see that evolve the following hours, following days. Okay, so exciting times in the market, and certainly watch it closely, especially if you have positions on, so you know how to manage those trades. JJ Wong, what tool can I use to find options with low implied volatility? I can show you. I'm running a little bit late, to be honest, but later I can show you something very quick that may be useful to you, JJ Wong. So buy and sell UFOs. We just saw UFOs kicking in. Okay, so we saw buy and field orders entering the market. So at least intraday, we would expect the market to move higher. And when it comes to volume, the interest map, so back to the map, but now I want to switch to open interest. So it catches my attention that the greatest open interest would be found here and here, which is 430. But as the market opens, we are talking about opening around 428. So it looks like the market is going to open gapping down, as we know from the futures markets, and it's going to open trading around 428. So if the market tries to rally back up, thanks to those buy and field orders, we may hit a very strong ceiling at 430. Okay, there is a lot of open interest, which may reveal the existence of a very strong resistance point at 430. So I would say we may have one of those days where the market rallies strong up, falls strong down, hit the UFO, rallies back up very strong, and we may have one of those days, like the climate says, is not confirmed, so we may have a sideways day when you look at the fact that on-field orders to buy came in, but also we have a very relevant resistance point identified thanks to the open interest of the options. Okay, this is options data, by the way. Okay. So interesting day for intraday traders. I guess you're going to be very happy taking trades up and down a few times a day. For long-term investors or medium-term investors, may not be the most exciting day today, but certainly you got close to 9,000 stocks in the US market. So if you look carefully, I'm sure you'll find your opportunities. Market volatility projections. Okay, this and the groups and the sectors is the last two pieces of analysis I want to do. So again, options are quite pricey these days. When you look at projections, you can see how the red line is beyond the blue lines. So from now until Friday, for example, which is, sorry, not Friday, right here. From now until the end of the day, Monday, I'm not sure why I'm thinking Friday. So we are expecting the market to range between 445 and 419. That would be the most based on the current prices of options. Okay, so that would be the expected range as a maximum. Okay, and you can see that the red line being beyond the blue lines represent the fact that people are buying options intensively. Okay, notice how the prices of options, both calls and puts, have been going up. There is a lot of call buying, there is a lot of put buying, even though the puts are winning. There is a lot of buying of options. People are expecting fast market movements. People are expecting volatility. And that's why the red line is beyond the blue lines. Okay, so keep that in mind. That's happening out there. And finally, from a grouping point of view, so here's the US market real time. If we look at it, midterm and long term, many of the sectors are in the red. Of course, we had multiple Elliott waves to the downside on the S&P already. So again, everything or almost everything is in the red. If we were to look at sectors that are potentially the strongest, we are looking at oil and gas. Utilities has just done a sector rotation here. So pay attention to this, because if the market decides to stop falling and start rallying, utilities may be an interesting sector, especially electric utilities that just rotated. Okay, just rotated. So we are talking about stocks such as EIX, AEP, PNW, PNM. I'm just pointing at some of the most relevant stocks here in this group. Of course, none of those are S&P 500 companies, but some of them are pretty relevant companies in the US market. So those companies, some of them, notice they are in the blue, they never went to red, and they belong to a sector which is now rotating up. So maybe this is a place, electric utilities, inside utilities, that may be a place where the good opportunities arise as the US market recovers, assuming our climate changes from unconfirmed to confirmed, and now we start getting direction to the upside, which again would be a little bit against what the options prices are telling us, with the puts winning versus the calls, with the Elliott wave pointing down. So, but sometimes the markets do change in an instant, and next thing you know, I don't know, they had chats in Ukraine and the chats were positive, and next thing you know, now the fear goes away, and next thing you know, the market rallies very hard. So something to watch. As I said a few times, we are at that very, very inflection point in the market at this moment in time, and it's something very, very exciting to watch from a trader point of view, and very critical in the world indeed. So we are basically done with the session. I want to point at how you get your own auto climate. Take a screenshot. I haven't forgotten about your question, JJ Wong. I want to show you very quick how you can find cheap options, options with low implied volatility in a moment. But I want to leave this QR code on the screen for just a moment so everybody can take a picture. Again, this the auto climate that I am granting you access here, keeping in mind the coupon code below Claimate. Okay, make sure you type that, because there is a fee of $8, but when you input this coupon code, it makes it free. So make sure you use the coupon code so you get it truly for free. And this auto climate runs on TradingView, which, as you know, you can also connect your TradingView to Tiger Brokers, and therefore you can get your market data, your analysis, and in this case, your climate, and get to understand the markets better. So do that. That will bring you to our website. You type the coupon code, you follow the steps, and our activations team will get you enabled. Typically it takes just a few hours, and you'll have those auto climates in your TradingView for life. Okay, which is a good one to have to avoid trouble. In any case, I think that you guys had time enough to take a screenshot. So I'm going to do this very quickly, because again, I have surpassed 2 weeks in a row, by the way. I apologize for that. I have surpassed the ending time, which is supposed to be 10 minutes ago. But I want to show you, like inside top, for example, the type of tools that we use to identify very cheap options. So for example, here, you look at options that where the continuous implied volatility is below the 20% of the range of implied volatilities. And when you do that, and of course, here I have other settings, which I would want to disable. Okay, here we go. Yes, cognitive. Okay, good. So when you screen for very cheap options, so automatically you get all those stocks. Now you got 9,000 stocks in the US market, and notice how I got a bunch of them with cheap options, but very, very few. And why is that? Well, because again, very few options are cheap these days, given the fact that many people are buying options heavily because there is a lot of expectation for volatility, and many people are betting on a move to the upside. Many people are betting on a move to the downside. Some are buying calls, some are buying puts, but there is a lot of options buying. You may want to check. There is a market which we'll discuss in a future session called the VIX, which represents the implied volatility of the US market, which is currently pointing at 31%. Okay, 31% at the open is going to be trading at 33.75. Okay, so very, very high. If I was to show you a monthly time frame of the VIX, and I was to show you data from the past, so notice that in normal cases, the VIX may be trading around 15. All of this is 15. We are currently trading at 33, which is more than double of expected volatility versus what tends to happen normally in a normal day, in a normal time. Okay, so that's why your list of options, your list of stocks with cheap options is reduced. But this is the type of tools that we use, JJ Wong, to find this type of setups that you're looking for, which is options with low implied volatility. Okay, again, more than happy to elaborate more on that in a future session, but for today we have to say goodbye now, and I appreciate you very much for joining me. Again, great fun for me as always to spend some time with you guys. It's always a very exciting time for me, and hopefully this is also exciting and very useful to you guys. Make sure you shoot me emails, send me questions if you have any question or you have feedback of things you would like me to cover in future sessions or anything. Happy to help. I will see you next Monday. Tiger Brokers, thank you very much for hosting the session and having me as well as part of your community. Thank you, everyone. Take care. Trade safe. Bye-bye.